Okay, guys, in the interest of time, we're going to get started here. So welcome to my webinar, Financial Planning, 10 Easy Steps. 10 easy things you can do right away to improve your situation both now and in the future in your retirement. So what we're going to talk about today, I'm going to explain a little bit about Raymond James, the firm that I work with, a little bit about myself, and then we'll get to our financial planning basic steps. So Raymond James is Canada's largest independent full-service investment firm. Our motto is client first, independent, conservatism, and integrity. We have a little circle here of some of the services that we offer to our clients. So estate planning, borrowing and credit assistance, funding children's education, protecting your income, protecting your assets, investment strategies, managing taxes, employee benefits, business succession planning, retirement planning, and charitable giving. Whatever your needs, we can assist you with planning for each stage of your life. A little bit about myself. What is a financial advisor? Your personal CFO and the hub of your financial network. I help with investment strategies as well as referrals and follow-ups with experts. So we have a financial planning team, an estate planning team, insurance professionals, lawyers, tax, accounting, et cetera. We also want to make sure that we're taking into consideration the effects of taxes and that we're not paying too much taxes and we can avoid taxes where possible. Managing and mitigating risk, both through our investment selection and use of insurance products. And I also act as a financial coach, helping you each step of the way to make better and better decisions as you go to make ensure that you're successful along your journey. Financial planning basics. What does it really come down to? A few simple things. You need to figure out where are you now and where would you like to be? And then how do we get there? Really that simple. And then we just set small achievable goals and go about attacking them. Your success will come through mindset, specialized knowledge, and a plan. We're going to talk a little bit about all three of those tonight. And when you get them working in tandem, then you'll be very successful in getting where you want to go. So step number one, net worth statement. First, you need to understand where are you now? If you want to book a trip somewhere, you're saying, well, I want to go to Thailand, I want to go to Mexico. First thing you need to figure out, well, where are you now and where's the nearest airport? So you book your flight from the airport that you're nearest to now. The same thing with the financial planning. You need to figure out, what does my financial situation look like now? So kind of the first step is to create a personal balance sheet. This is, sort of your net worth overall, which is the culmination of your assets minus any liabilities or debts. Once you have this created, then you can update it annually and make sure you're still on track. So a little bit more, kind of an example of what a balance sheet would look like. So your assets, this is anything that has value to you. So cash in the bank, any of your investments, your tax-free savings account, RSPs, things like that. The value of your home that you live in or any other properties, your automobile, and then any other high-ticket items you might own, like furniture, jewelry, etc. Liabilities, these are things that you still have to pay for. So the remaining mortgage balance on your home, any car loans, student loans, personal lines of credit, and credit cards. Step number two, review your budget cash flow. This is just, making sure that you're keeping track of where the cash is coming in and where is it going out. A lot of people, they look at their bank statements, but maybe not in detail, and they don't really know or have a clear picture of, what their potential is to save, because they may be bleeding money out in places that they haven't thought about. So going through and reviewing your budget, either, month to month to start, and then maybe year to year after that. You're just looking at your income versus expenses, updating any material changes, plan for special occasions and unexpected expenses, how much is left at the end of each month, and then determining what your goals and objectives are. So being really specific, like what debts are you paying off? What's the current balance? How long till I pay off that credit card and am I on track? And keeping myself motivated to do that. How close do you stay on your budget month to month? Does it go up and down a lot, or is it fairly consistent? And where is it that you go off track if you do go off spending a little bit more than you anticipated? The other thing, is can any of these expenses be trimmed? Maybe you have an old Netflix account you never use anymore. You've been on, watching Amazon Prime for the last 6 months. Well, why don't you just cancel the Netflix account? Little things like that can really add up and make a big difference in the long run. And then, just monitor your results as you go. So here's an example of a monthly household budget. This is in Excel spreadsheet. If you have Excel on your computer, there is some templates for you to use to get started. But if you don't have Excel or a computer, don't worry. You can do this with a pen and paper. And I actually encourage my clients to do this exercise with a pencil and paper, especially if it's the first time. Just something about writing things down manually that has a little bit of a different effect on the brain and can actually really make a big difference in helping make those decisions. If you have to write something down, you're forcing yourself to think about it and say, do I really need this expense in my life? Step number 3, pay yourself first. Saving shouldn't be an afterthought. You want to pay yourself first. That means you pay off your bad debts, then you invest, and then you pay your monthly expenses, and then you have anything left over. That's your fun money. You can automate this process. You create an auto transfer that coincides with your pay period. Do it on the same day that your paycheck comes in. The money goes out to pay your debts, goes to your investment accounts, auto pay your bills, and then it just takes a lot of the guesswork out and it makes it easier to stay on track. How much you should be saving, 10% of your income plus. I'm going to tell people, it should be like 15-20% ideally. You want to pay yourself first. A lot of people have, competing priorities. They want, to buy a new sled, a new quad, go on a holiday, have the RV, the kind of YOLO thinking. But really it's yo-yo, which is, you're on your own. Your present self has to take care of your future self, and you do that by saving today. What is the value of saving? This is a little chart showing what the monthly savings needed to achieve $1 million at retirement at age 65. You can see here very clearly and quickly that the younger you are when you start saving, you have to save far less, and the longer you wait, the problem is just going to compound and get exponentially more difficult. Really important to start as early as you can. Start yesterday, start today. It's going to go a long way to make things a lot easier when it actually comes to retirement. A lot of people wait till they're 5-10 years away from retirement, and in many of those cases it's almost too late, and it's just damage control at that point. So start early. Get your kids started early. Young people that maybe you're mentoring young people in your work or in other parts of your life, just let them know this one important lesson, if nothing else, that the sooner they can start saving, the better off they're going to be in the long run. Step number 4, designate and update your beneficiaries. Take a look and make sure that you have a current beneficiary on all of your registered accounts. So like things like your RSPs, TFSAs, RIFs, all those have a named beneficiary. And what that means is if you were to pass away, that money would go tax-free directly, bypassing probate and all the legal things that go along with an estate, and they just go right to that beneficiary, so they can get use out of that money right away, or they can add it to their own investments and start reaping the compounding interest right away from that money. So really important. Otherwise, it's going to go to the estate. There could be taxes and other things tied to not having a beneficiary. So that's really important. And it's something that's fairly easy to do. Just, give your advisor a call, or, go at the bank, make sure that those beneficiaries are named and updated, and make sure that they have the correct addresses as well. If they can't get a hold of the beneficiary, the money can just sit there. They can't make trades on the account, and things can uh, go south pretty quickly. So just make sure that everything is up to date. Just takes a few minutes. Step number 5, revisit your portfolio's asset allocation and asset diversification. So what is your current allocation? Are you invested in all high risk? Are you all low risk? Are you concentrated in Canadian investments, or do you have a good global exposure with your investments? Do you need to do some rebalancing? What are the levels of risk that you're comfortable with? Maybe those change over time. You get older, income levels change, your goals change, your risk level can change as well. And it's important to revisit that periodically and make sure that you have overall good diversification. So I have a little picture of the ski hill here with the chairlift, and kind of what I wanted to talk about there was, what is asset diversification? Some people might be thinking right now. So if you think of somebody who owns a ski hill, they are very concentrated. They don't have any diversification. They're relying on one source of income. And you can imagine that in the summer, their income is probably zero because there's no snow. So what's one way that they could diversify to just solve that issue? Well, maybe they use some of the profits from their ski hill to buy a golf course. Now in the summer, they have some income coming in through the golf course. And when the ski hill is closed, and when the ski hill's up and running, the golf course is closed, and there's probably some crossover in the shoulder season. So it's just a simple explanation of one way to diversify through asset allocation. And of course, you can extrapolate from there that you could go on and on and on with more diversification. And in many cases, a lot of people are not diversified enough. Asset allocation. Let's just talk about the risk return trade-off a little bit. So here's an example of 5 different portfolios on kind of a risk return line. So as you go out to the top right, you're taking on more risk and you're expecting more of a return. So that's where you see a portfolio of mostly stocks with a little bit of cash, a little bit of bonds in there. And then on the bottom right, you have very low risk, but also low returns. So this portfolio is mostly cash with maybe some bonds and GICs in there. So it's important that when you're taking a look at this stuff, you want to make sure you're at the right spot on this risk return line that's appropriate for your age, your goals, your timeline, and your risk tolerance, or even just your capacity to take on risk. Oh, so carrying on, here's a couple of just rules of thumb. Diversification. So what is the size of each position? You don't want to have more than 5% of your net worth in any one investment. You want at least 20 or more holdings in your portfolio. You don't want them all in the same country. You don't want them to be all the same type of investment. And you want to consider your other assets as well, your home, what industry you work in, and your human capital, or the skills that you have. So a good example would be, somebody who lives in Calgary, they work in oil and gas, they've worked in oil and gas their entire life, and they have an investment portfolio that's full of Alberta oil and gas companies. Well, they're not very diversified at all. So sure, they have a home and they have some skills, and they have some different types of investments, but they're all tied to the price of oil. And when that price of oil comes down, as you know, all these different assets in the portfolio all come down at once, and maybe you're even out of a job because you work in that industry. So that's why it's important when you're looking at this stuff that you consider all the pieces of the puzzle and make sure you have diversification across your entire net worth. Step number 6, evaluate your sources of income and your retirement statement. So in retirement, you're going to have more than one source of income. So it's important to identify those early and make sure that they're going to be enough. So you have your old age security, Canada pension plan. Maybe you have a pension plan through work or an old pension from a previous job. You have some RSPs, TFSAs, maybe a rental property. Evaluate how reliable each source of income is. You can go online on your account on My Service Canada, and you can see what your potential OAS and CPP amounts might look like. And you can view earnings history for accuracy, compute expectations at various retirement stages. All this means is, what year am I going to retire, and what sources of income am I going to start to draw down on in that year that I retire? Step number 7, check to see if the plan is on track. So this is a screenshot of some software that I use to help my clients do some of these calculations. Here's an example. Somebody, they say, I want to retire at, I'm 49 now, I'm going to retire at 55. And we can run the numbers and we can see that by the time you're 69, 70 years old, you're actually gonna you're gonna start to run out of money from your investments, and you're going to be basically completely reliant on CPP OAS at age 70, which will mean a significant drop in income for you. So it's important that you run these calculations and make sure that you know exactly what they look like and what you're in for, as opposed to saying, I'm just going to arbitrarily retire at age 55, not knowing if you're safe to do so or not. So that's something you definitely want to look into with a financial professional. Step number 8, ensure you're not leaving money on the table. Participate in employer-sponsored benefits, so all your stock options, your RSP matching programs. Make sure you're taking full advantage of that. If you put in 4% and your employer matches 4%, well, you just made an instant 100% return on investment. And it's really hard to beat that. Even Warren Buffett doesn't do that well. What return are you getting on your cash? That's a really good question to ask. So if you have a savings account or just a large amount of cash in your checkings account, maybe it's time to move some of that over to like some money market funds or some short-term bonds, or anything that you're not going to need to touch for the next 6 months. You could put it in a high interest savings account. Just do something so that you're earning at least some interest on your cash at all times. The other thing you can look at is fees. So you can look at the fees you're paying on your investments. But even just banking fees, sometimes they can be negotiated down. All the banks are very, very competitive with one another. They're all competing to try and get more and more clients. Sometimes just moving from one bank to another, you can save yourself half your fees just by moving over and taking advantage of a new lower rate for new customers. So something to consider, take a look at. Growing your wealth by investing. Here's just a quick look at compounding interest. So initial amount, $100,000 investment, compounding annually over 10 years. And there's your outcome after 10 years with different rates of return. So you can see that having a good rate of return on your investments can make a big difference in your net worth over time. And it's something you want to be watching closely, making sure that you are at least keeping up with market returns on a stock portfolio that would be 10% over a 30-year period of time annualized. Step number 9, protecting yourself from the unknown. You definitely want to have an emergency fund that's easily accessible. The amount may depend on your unique situation, like your job security and what your expenses are. So if you work in oil and gas and you have maybe a more precarious job position and you have really high monthly expenses, well, you better have a pretty big emergency fund, because even with a severance package you may get with a layoff, you don't know how long it's going to take you to find work with the same income again, and you want to make sure you have that buffer there to tide you over. Same thing with your insurance policies. Are you insured? What type of policy do you have? Do they meet your current needs? If you're in a job transition and you're going from group benefits to, say, contracting, you have a 30-day period to move those group benefits over to an individual plan. So that's something you'd want to take a look at as well. Do you have a will, personal directive, enduring power of attorney? Are these up to date? Are they still even legal? You know, the do-it-yourself at home will kit that you got from Staples 10, 15 years ago is probably not even a legal document anymore. So you want to review this with your lawyer and make sure that everything is up to date and good to go. We recommend to our clients, they want to take a look at this at least every 2 years. Step number 10, get yourself an accountability partner. Motivation will get you started, but to sustain the results, get yourself a buddy, somebody to help you stay on track. It's going to be more fun along the way. This is exactly the same as going to the gym, getting in shape. If you have a gym buddy, somebody to keep you motivated and you know, you go with them 3 times a week and you keep each other on track, is the same thing with your finances. There's no benefits to being silent about money and your financial situation. Everybody has something to learn from someone else and gain a better understanding of what's out there. You know, find somebody in your family, find a close friend, you know, somebody you trust, and partner up with them and say, let's do this together. Let's learn what we can together, and we'll both be better for it. You can use a financial professional as well for this. I do this with all my clients as well. Bonus step number 11, commit to expanding your financial knowledge. So never stop learning. Changes are constantly happening. You want to seek out every opportunity you can through webinars, seminars, books and articles online. There's tons of great information out there. Ask a friend, family member, colleague, financial professional. I do monthly webinars, and I also do a weekly newsletter on Fridays. If you want to sign up for my newsletter, go ahead and shoot me an email. The email is below, greg.wood@raymondjames.ca. Just say, hey, can I be on your Friday newsletter? I'd like to learn more about this stuff, and I will send that out to you. So that's all I got for now. If you have any questions, type them in the question